Small cap stocks versus large cap stocks. What's the difference? The number of shares of a company stock is multiplied by the stock price to get its market. Market capitalization refers to the value of a company's total outstanding shares. Welcome back, y'all. You may be familiar with stocks, but how do you know the distinction between small caps and large size stocks? Here we go. Small cap stocks. Smaller firms have fewer publicity listed on shares than larger or mid cap companies. As previously stated, the total monetary worth of all outstanding shares held by investors, institutional investors, and corporate insiders are between 300 million and 2 billion. Smaller companies with fewer shares. As a result, these stocks may be lightly traded, and transactions may take longer to complete. The small cap market, on the other hand, is one area where individual investors have an edge over institutional investors. Institutional investors are less interested in less size small cap offers, since they acquire huge blocks of shares. If they did, they end up owning and managing a percentage of these smaller firms. Small cap companies continue to struggle with liquidity, which is pretty frustrating for investors who pride themselves on diversifying their portfolios. This variation has two consequences. Number 1, a share in small cap companies may be difficult to sell when the market has less liquidity. An investor may discover that buying or selling specific holding with daily trading activity takes longer. Small cap fund managers close their funds to new investors when their assets under management drops below a certain level. Large cap stocks. Shares of companies having a market value of 10 billion or more are known as large cap stocks or big caps. During turbulent markets, large cap stocks tend to be less volatile as investors seek quality and stability and become risk averse. Names like Apple, Berkshire Hathaway, and ExxonMobil make up over 90% of the American stock market. The Dow Jones Industrial Average and over the Standard & Poor's 500 are the two indexes and benchmarks that track large cap businesses. Large cap companies make up the majority of US equities market. Therefore, they are frequently considered fundamental portfolio assets. The following of some of the characteristics that are frequently linked to large cap stocks. Number 1, transparent. Large size firms are generally transparent, making public information about them are easy to locate and evaluate for investors. Number 2, dividend payers. For dividend income distributions, investors frequently select a large size, reliable, established firms. Their established market positions have allowed them to commit high dividend payment percentages. Stable and influential. Number 3, large cap stocks are generally blue chip businesses amid an economic cycle apex, generating predictability, revenue, and earnings because of their scale. They follow the market economy, and they're also the most powerful players on the market. They provide novel solutions, frequently in conjunctions with worldwide market operations, and market news about these firms have a significant influence on the whole market. Large cap versus small cap stocks. What is the difference? Number 8, market capitalization. As I previously said, the greatest distinction between large cap and small cap stocks and companies is their market capitalization. Small cap stocks typically have a market valuation of up to $67 million. Large cap stocks are those belong to firms that have a market capitalization of more than $950 million and a market capitalization of $270 or more. Number 7, the growth curve. Another distinction between small and large size companies is their growth curve. Small cap stocks are those that are still in the early stages of their expansions. It might be a fledgling business or startups. Large cap stocks, on the other hand, belong to well-established businesses with a record of successful growth. Number 6, dividend payments. Dividend payments are another factor that distinguishes small caps from large cap stocks. Dividends are paid by large size corporations to their shareholders regularly. Small cap firms, on the other hand, do not have a high probability of paying the dividends because they are on a growth plan. Small size firms may need to direct their cash for reinvestment. Number 5, stock price. Stock price differs largely between large and small size stocks. Small cap companies have yet to establish themselves, thus their stocks are less expensive than large cap corporations. Stocks with a larger market capitalization are more likely to cost more than those with a smaller market capitalization. Number 4, liquidity. Due to their popularity and track record, large cap companies are very well liquidated investment options. Large cap stocks have been around for quite a while and are well known. Small cap companies are less liquid since a few investors are familiar with them, and selling them can be time consuming. Number 3, volatility and risk. The risk and volatility aspect is a major distinction in the small cap versus large cap stock. Large cap stocks are often more stable than small cap companies, but small cap stocks provide a possibility for growth. Both large and small cap stocks have advantages and their disadvantages, and a portfolio that includes both types of equities may be more dispersed. Number 2, the market presence. When deciding between a small and large size stocks, it's important to consider the idea of a market presence. Large cap stocks stand out and are easy to follow. They provide frequent financial data, and many investors are going to easily look them up without exerting too much work. Large cap businesses are required to produce and make public their financial accounts and records. Small cap stocks, on the other hand, may be well less known, making tracking information about them even more challenging. Number 1, before investing, assessing your tolerance risk. Small size stocks may suit individuals with a high risk tolerance in terms of investing, whilst large cap stocks may suit for those who are risk averse or have a low to moderate risk appetite. You may want to choose between the small size and large cap stocks depending on your investing style. When choosing a market cap stock, one should consider their risk portfolio, investing horizon, and ambitions. The key differences: large cap stocks have a dedicated audience, and investors have access to a variety of financial records, independent research, and market information. Furthermore, large cap move a larger volume and have a higher market efficiency than their smaller relatives, trading at values that represent the underlying firm. Small cap stocks are more volatile and risky investment than large cap equities. Small cap companies have a limited access to finance and on average fewer financial resources. This makes it difficult for smaller businesses to get money they need to bridge cash flow gaps, fund new market expansion efforts, or make substantial capital investments during economic turndowns. This challenge can become much more severe for small cap firms. Despite the risk, there are compelling reasons to invest in small cap firms. One advantage is that businesses may achieve proportionally higher growth rates and more easily. Sales of 500,000 can be easily doubled, but sales of 5 million are far more difficult to double. Furthermore, because smaller businesses generally have a smaller and more intimate management team, they can just adjust changing their market conditions more rapidly, similar to how a tiny boat may change directions more quickly than a big ocean liner. Large cap stocks, on the other hand, aren't always the best position. As firms get older, they may have fewer possibilities for development, and they may be less adaptable to the shifting economic trends. Several major corporations have encountered difficulties and have fallen out of favor. Just because a company has a big market capitalization does not imply it is always a good investment. You must conduct your homework, which involves looking at other smaller firms that can serve as a solid foundation for your investing portfolio. Small cap stocks versus large cap stocks. An overview. Market capitalization, defined as the total value of all a company's outstanding shares, has historically had an inverse or opposing connection to risk and return. Large cap firms, defined as those with a market capitalization of $10 billion or more, expand at a slower rate than mid-cap companies on average. Companies having a market value of $210 billion are classified as mid-caps, while those with a market capitalization of $300 million to $2 billion are classified as small caps. The definition of large cap and small cap obviously varies among brokerage companies, and the dividing line has shifted throughout the age. The terminology variation are minimal, and they only influence businesses that are about to enter the market. Stock are divided into 3 categories based on their market capitalization: small, mid, and big caps. Small cap stocks are those who have lesser than market capitalization and are establishing themselves. There are other in fancy ways and are now just starting to grow. Large cap corporations, on the other hand, are well-established businesses that are sometimes market leaders in their industries. They provide stability and are simple to investigate and monitor. Small cap are less well known. Therefore, investors may need to do additional research and tracking before selecting the right small cap company. The major stock exchange and entices also belong to a large and small, which adds to the confusion. Have you tried stock simulators before? Do you know how to evaluate and analyze a stock? Tell us all of these in the comment section down below. Anyways, guys, I really do hope to see you guys in the next one. Bye bye.